Hey guys, welcome back. In today's episode, I want to talk about 4 dividend stocks I'm going to buy today, as well as an update on my portfolio. As you can see, my portfolio is currently sitting at $89,000. I put some money to work last week to buy more stocks that you can see in the following slide. Overall, I currently have an asset allocation of 73% stocks, 16% bonds, and 11% cash. I will use some of the cash to buy the stocks I'm mentioning later on. Due to the contraction in the real estate sector, I picked up some REITs as they are all way below their all-time highs. Most of them were 50 to 70% down and they pay a very solid dividend. This is obviously a risky sector in this environment, but I tried to focus on quality holdings. The only holding I had was Realty Income Corp before the pandemic. With the risks of defaults of rent, the sector has been hard hit, but I believe if you have a longer investment time frame, this might be a good deal now. There could certainly be more pain in the near future, but personally I think the sector will recover and you can collect dividends along the way. Overall, my portfolio still has a high tilt towards technology, which is doing very well in this environment. But I want to add some healthcare and defense stocks going forward. That's what you're going to see today. I will continue to look for distressed stocks with potential upside during this crisis. Please let me know in the comment section what stocks you're looking at today. If we look at the sector breakdown of my portfolio, we can see the highest allocation of technology as mentioned. Real estate is slightly high at the moment, but I probably won't increase the sector unless I see more bargains out there. Overall, I plan to bring up some of the other sectors. But now let's move on to the stocks I'm adding to the portfolio today. First off is the German software giant SAP. It's an existing holding for me, but I believe they have a very solid business that should not be impacted by this current economical contraction. The core bullish case for SAP is still intact. A global software giant sitting in the pole position for many software categories like ERP, procurement, and others. SAP's continued move into becoming a subscription-based company is still underway as it plans to triple its cloud revenue within 3 years. I certainly like the new management team and the focus on software as a service plus solid acquisitions in the past. The dividend yield of 1.5% is not very high for an income-oriented portfolio, but still fairly decent for a software company. High dividend safety score from Simply Safe Dividends and a PE ratio of 30 makes it a solid play for me with potential stock price upside in the future. AbbVie has long been a dividend growth stock that I was planning to add to my portfolio. AbbVie is providing the quality that we need in this choppy market and pays a dividend of over 5%. The company hits this stride beginning of 2018 as Humira sales skyrocketed the stock to its all-time high of $125. Today the shares of AbbVie are trading around $80, which is roughly a 35% drop from those highs. At current levels, AbbVie is now trading at the same level it was when it announced the acquisition of Allergan last June, which resulted in a 20% sell-off in the following weeks. AbbVie is primed for strong growth in the years ahead, and I believe that the addition of Allergan will only further build that up. The debt levels in the company have been a worry for many investors, and is probably the main reason for the sharp sell-off, as well as the 50 score for Simply Safe Dividends, as the rise of debt might impact the dividend payout. The Allergan acquisition is supposed to close early summer if all goes to plan. Keeping a close eye on debt will be important for investors, as debt will be quite high, but the new combined company will produce strong operation cash flows for the foreseeable future, which would lead to further growth and dividend increase for investors. Before I discuss the last stock, please subscribe to the channel to get updates on all things investing and hit that like button. I'm still waiting. Okay, finally, thanks. Let's move on to the last stock. Okay, the last stock I'm adding is Raytheon Technologies. Last year, United Technologies and Raytheon announced that they're going to merge their operations. The newly formed merger of space and defense company Raytheon with the aerospace business of United Technologies was supposed to come at a time of good growth in the commercial aerospace, backed by solid growth from the defense business. Unfortunately, that didn't really play out due to the COVID-19 pandemic. Looking ahead, the commercial aviation market will surely recover past COVID-19. The real question is about the timing and the shape of the recovery. The recovery will probably be slow, but the engine maker will most likely not be as severely hit as the airlines itself due to a solid backlog and strong long-term growth. In the meantime, RTX was supported by its defense-related earnings, expected to grow at a mid-single-digit rate in the medium term, while investors wait for the recovery in the commercial aerospace market. The company to trading on such low valuations that I think is very attractive. The new company hasn't declared dividend payments yet. However, Raytheon and United Technologies pay a growing dividend for decades. My assumption here is that we can rely on a dividend in this case as well. The earnings call on the 7th of May should provide clarity. Therefore, this is a slightly risky pick in the short term, but I see a bright future for Raytheon Technologies. So, there are my 3 stocks I'm buying today. What's on your watch list for this week? Please comment in the comment section. Again, thanks for watching. Please subscribe to the channel, and I see you on the next episode.